it's going to destroy people's lives. And you don't have to be a part of that. I always recommend holding 5% of your assets in gold. So there are times you want to overextend in gold like we are now. But there might be some time in the future when, when we reset the currency and we have some sanity in Washington, when we have low taxes, low interest rates, low inflation, the stable currency. And you might not want 20% or 17 or 15% of your portfolio like we are now in precious metals. You might want a little bit less, but you should never wed yourself to a 60-40 or 70-30 or 50-50 portfolio ever, because it used to work decades ago. It doesn't work when both those asset classes are in massive bubbles that will mean revert.
Michael Pento, a respected economist and market strategist, is once again sounding the alarm on the fragile state of today's financial system. He emphasizes that the conventional investment mix, the classic 60-40 or 70-30 stock-to-bond portfolio, no longer provides the protection it once did. The reason is simple. Both asset classes are caught in simultaneous bubbles, and when they begin to unwind, the fallout could devastate millions of investors. In this changing environment, he advises individuals to rethink how they allocate their wealth. Holding a portion of assets in gold, traditionally around 5%, has always served as a safe haven. But now, with rising debt, unstable currencies, and mounting inflation, he believes a stronger position in precious metals is warranted. Gold, in his view, isn't just an investment. It's financial insurance against government mismanagement and central bank excesses. Still, he remains pragmatic. Once stability returns, when interest rates, taxes, and inflation fall, and when fiscal responsibility is restored, investors may choose to reduce their exposure to metals. But until then, he warns, it's critical to protect your wealth before the coming economic reset erases trillions in paper value. For more insights like this, make sure to like, subscribe, and stay tuned.
We had a secular bull market in precious metals that went vertical. It just went linear. And in my opinion, at this juncture, this moment, it's a healthy, necessary pullback in the bull market of precious metals. Because look, I mean, here's the facts. The Fed is panicking now. They're actually in panic mode. They're not panicking to raise interest rates. They're now going to actually accelerate the monetary debasement of the dollar, because they're cutting interest rates. They're going to cut again next week, second time. This is before the new chair comes in May of 2026, and who's going to cut rates even more aggressively. The Fed is ending quantitative tightening. As a matter of fact, I checked yesterday, I looked at the Fed's balance sheet. Quantitative tightening means you're actually shedding assets, so you're draining the balance sheet. The opposite is, since October 1st, the Fed's balance sheet has been increasing. So they're already in the process of quantitative easing, and I think that accelerates under the new Fed chair, it coming in 26. And then is China now selling gold to stockpile treasuries? Is Russia doing that? So I mean, so there's nothing really has changed. Has the United States paid off its debt or deficits? The deficit this year is the same as it was last year, despite all the revenue that we're taking in tariffs. It's the same number, $1.8 trillion. That's not my opinion. That's a fact. So from the Congressional Budget Office. So deficits are still dangerously high. Debt is over the top. We're monetizing debt at a faster rate. So until one of those things changes, then I will say, well, maybe this is the end of the bull market in precious metals. As of right now, it's just a necessary sell-off that should be bought. Now, if it continues to erode, you're going to break some support here, and it might last longer. It might be a significant pullback. But at this moment, it's a very healthy correction. The U.S. dollar is going to lose its world reserve currency status, and it will. And people say, well, when is it going to be replaced by the yuan? China doesn't have a free-floating currency. Well, listen, it's going to be replaced by, and it's being replaced by, gold. Because gold is not, if China sells us excess goods and they have a currency surplus, and they used to want to park it in treasuries, which are backed in dollars, and those treasuries and dollars are now subject to tariffs and confiscations, and they say, well, wait a second, I'll just take my surplus and buy gold, and I will hold it myself. And what does the government do when there's a crisis? In the past, this nation has done two things. They've printed a ton of money. The Fed knows that all of that excess liquidity that the banks had parked at the Fed is now gone. So they don't want another repo crisis like they had in 2019. We're on the threshold, the doorstep of another one. So they're preemptively, obviating the need for that aggressive rate cutting and to, spike the balance sheet by $1 trillion. They're trying to get ahead of that by now ending QT, lowering interest rates, and rebuilding the balance sheet. It's funny that the balance sheet was $700 billion prior to the global financial crisis. It spiked to $9 trillion. They managed to get it down all the way to $6.3 trillion. From $700 billion to $6.3 trillion. And the reserves in the system were almost negligible, almost zero. And they spiked through more. As a matter of fact, I'm going to put on my web, as part of my midweek reality check this week, I'm going to put a chart up of reserves in the financial system and show how they spiked from like zero to over $3 trillion since the global financial crisis, and then really went ballistic after COVID. And there's still, a superfluous amount of reserves in the system, and yet they're adding those reserves. So you want to understand why people are pining for an alternative to the US dollar, and they're running into this like crazy stuff like Bitcoin. But in reality, what they need is gold and silver and platinum. And that's what's happening. So that's why I think, again, as of now, it's just a healthy pullback in the precious metals complex, which if you have the courage to step in when silver's down 8%, you might be rewarded a few weeks from now.
In a rapidly changing economic landscape, the current pullback in gold and silver isn't a warning sign. It's a natural breather in what many view as a powerful ongoing bull market. Despite the short-term volatility, the fundamentals remain the same. Debt is soaring, deficits are widening, and the Federal Reserve has quietly shifted from tightening to easing once again. Since October, the Fed's balance sheet has grown, signaling that quantitative tightening is effectively over. With more rate cuts expected, liquidity is flooding back into the system. Meanwhile, global confidence in the US dollar continues to erode. Nations like China and Russia aren't rushing to accumulate US treasuries. They're turning to gold. This shift reflects a deeper truth. Gold is becoming the preferred store of value in a world skeptical of fiat promises. The Fed's monetary maneuvers, rising debt, and persistent inflation reinforce the case for hard assets. So while market sentiment may seem shaky, the foundation beneath gold and silver remains strong. For long-term investors, this pullback isn't a cause for panic. It's an opportunity to accumulate before the next leg higher. Let's get into the interview.
For me, it means that inflation is heading higher at a faster rate. So we're growing at 2.7% year over year now. This next print, whenever we get it, because the government's closed, but we're going to get a print on Friday, and I think it's going to be 3.1%. That's higher than 2.7. So the rate of change is accelerating, and yet we see the Fed, for some unknown reason, is anxious and now panicked to cut interest rates, end QT, and re-enter QE. Even though we spent 4.5 years above their silly, ridiculous, derisive target of 2%, and we're 50% above 2%, heading further away from 2%, and they're cutting interest rates. Ask the people in Japan. I've said this before, but it bears repeating. I mean, we're not immune from the laws of supply and demand and macroeconomics here. It took 35 years for that index to recover from its bubble high. The Shanghai exchange is still down about 45% from its 2008 high. It took 15 years for the market to recover post in the Great Depression, the 1929 debacle. And as I hopefully eruditely described before, if stocks and bonds are in a bubble, a massive bubble, and credit is a bubble, and housing's in a bubble, we've never had such a bubble, the triumvirate of bubbles, that they all burst, and there's nothing the federal government can do about it because it's bursting because of insolvency, debt, and inflation, then it might take decades for you to get back to even in nominal terms. You could just cancel your retirement if that's the case. And we don't want to do that here. We have a smart way of looking at things. I have in my Pento portfolio strategies, we have a 5-sector spectrum that ranges between deflation and intractable inflation. Looks at the second derivative, so it's the rate of change or the rate of change. And it informs me what stocks should I own? What stocks and ETFs should I buy? What bonds should I own? Should I own treasuries, T-bills, or should I be shorting bonds? What commodities should I own? What currencies do I need to own? And if you understand that, you can ask yourself this simple question. This is a scenario. In a deflationary bust of the economy, a deflationary depression, you would want to overweight fixed income, right? And you want to underweight the highly speculative stocks which have led this market. The market has been led by the unprofitable Russell 2000 companies. That's emblematic of a bubble.
Inflation isn't slowing, it's accelerating. With annual growth now around 2.7%, projections point toward 3.1% or higher. Despite this clear trend, the Federal Reserve is rushing to cut interest rates and reintroduce quantitative easing, a move that seems completely detached from reality. History has shown that no economy, from Japan to China to the US in 1929, escapes the consequences of runaway debt and inflated asset bubbles. Each of those collapses took years, sometimes decades, to recover from. Today, we're facing something even more dangerous: simultaneous bubbles in stocks, bonds, credit, and housing. When these finally burst under the pressure of debt and inflation, it won't just be a market correction, it'll be a generational financial reset. That's why understanding the macro picture, the rate of change, as some call it, is critical. Knowing when to pivot between assets, when to hold hard commodities, and when to move defensively could determine who survives this transition and who doesn't. The warning signs are clear. The time for complacency is over. Like, subscribe, and share your thoughts. Let's keep the conversation going.